Here we go. We're going to introduce the wonderful name called CME. That's the symbol, Chicago Mercantile Trades, as a listed stock. And we're entering this one even though that we've traded it for a number of many years. But we are introducing it to a new breed of MMT market makers. And within that structure, we're going to also introduce, and everyone already knows how much we trade CMG. What we're going to be doing with our new enrollees is we're clearly going to be defining directional price movement and what the similarities between these two names have. How does one identify a support level in our system and how prices work with either electronic high-frequency volume computing machines versus the natural human being in the tape? That is, people like ourselves that are the natural buyers and sellers, floor traders, market makers, institutional hedge fund managers, mutual funds, and so forth, and the broader tape of Wall Street and their capacity roles. One of the things that have happened in modern times today versus other points in history, such as, well, what was different between the 90s, what was different, how did the 2000s, and how did the world change, and what goes involved in making a price movement, directional price movement plus, and what is the system going to do here is that on the CMG trade, you can see 1 teeny, 2 teenies, 3 teenies, 4 teenies, 5 teenies, 6 teenies, 7 teenies, the consolidation, 8, 9, and 10 teenies to the top. And this was on November 11th. And this was the time that the trend had put in the bottom, the diamond pops, the half bar support levels. You can see that each line is based on a teeny line. In this case, I have a teeny value, if I'm correct, 78 cents in our market maker platform that does all the pricing and everything for you. Now, it's a listed stock, and it's in the restaurant category, but it's a high beta listed stock that is automatically placed in the market maker trading division. Thereafter, what we are going to focus on is how its partner stock had the same kind of breakout here on CME. And you can see that once we come down, that each one of these teeny lines, this is a market maker application, but they both have something very in common. They have to have qualifying bars on breakout. So when the top right here had this big 3-minute breakout bar, and so what, milliseconds that goes down, that's an electronic machine in the electronic buy and sell transaction. You have an immediate turnaround, but you're holding the half bars and they're going up. Look at the CME trade. It pops straight up, but look at its resistance level and look at the qualifying bars. Always these qualifying movements, you want 2 teenies through resistance, and you did get it from this teeny right here, 1, 2. And that teeny line, as we know it on CME, is, I have, let's see what we have, 69 cents. I'm going to double check it. Here, 46 cents a teeny will be what will Monday's teeny be. So each one of these lines here that we see in the chart for CME, this is CME here, and we're only focusing on this part of the video of where the breakouts occurred in both of the names. And how do I identify 1, 2, 3 teenies up? How do I identify the confirmation breakout to the upper teeny line? How do I consolidate a teeny line? And how do I break higher through the upper diamonds of the teeny reversal? But look at this diamond right across here, and how do I identify that ascending mathematical breakout equation to the very top of that structure? On the very same note, right back over here in the CME trade, which is here, the CMG trade, is it trades a little different, but once again, this is where you got through it with the qualifying upside bar. This bottom bar to that low teeny, you must have, again, take a look at the teeny low. 1 teeny, 2 teeny, 3 teenies mathematically to the line, to the penny. No one's going to deny us of that. Nobody can do that. And it came right up there to that neckline. Then you come back and even get down here to this half bar, but immediately you're back above the teeny line, and in CMG you can see where the diamonds were getting higher. And then the platform give us a triple diamond alert. And even though within milliseconds, this is all done electronically. This is not a buyer and a natural seller. It's a high frequency volume machine. But even so, the SMF platform is a market maker platform, not a day trading platform or any of the ones you know about or seen on the internet. This is quite different. Look at the diamond pop.
Is that where you would get in?
Yeah, you would. Because when you're buying through a major breakout, you're absolutely right, Mike. You would come right in there, and you'd have to have from the breakout point 1 teeny, 2 teenies, and you pull back and hold these half bars in here, and you're bid popping, and you will pull back because these are where they drop the bid. They sell the bid down in the bid and ask. But you'll notice that the diamond structure always remains elevated. They're not breaking back down. They're not closing below the previous half bars here. Look at the support level. And you always have to have a reversal. When you got her up at a high here, this is the qualifier. Always 100%. Never go against it. Because if you do, you'll lose. You must have that teeny expansion in these kind of 3-minute bars where they popped the ask higher. Someone bought way above the market to create the print. It comes up, but it holds that diamond. But look what the qualifier always is. That bid pop. That bid pop. And then that 3-minute full teeny value, and that the body of the price of the candle here is all the way up at that diamond top. And that's where we start to make that top from that opening bell entry on CMG New Edition. On the CME, same rule applies because you can see the same area of where you would. So let's say, but you always want to learn that the market maker is getting the turn down here and how to identify the turn here. And then you can validate the position as it breaks through with the qualifier with getting above where that reversal was. You take that out, but you got that. Look at that bar. That is the qualifying bar against the red bar. You must have that. You must have that breakout bar. That must come. And even when you pull back a teeny, the strength of the pullback, mathematical strength, is strong in the math, and you can consolidate. But every time you must ascend. But then when you're going to go through that upper end of this resistance level, you must once again break higher a teeny line, and you must have an ascending price action going in that direction, even within the small volatility. But what are you seeing in the characteristics of it before this one makes its high is that you had a pop. Someone bought the ask higher, and then bam, right to that teeny line. And this is where the weakness finally started to come in. And this too was an intraday opening turn. They sold the CME down. This is where that turn, and these are the validators and the verifiers in our platform. And what are they? They're all mathematical in here. This doesn't run on the weekends, but during the live trading days, you'll learn what it all means. And what it means is it doesn't have any lag whatsoever, Mike, in directional price movement. In this case, both the new additions for this group is to learn that the high beta, which means the higher dollar price range intraday, that means the higher beta, which equals higher mathematical dollar price movements in the plus, and also vice versa would be the D minus directional price movement, which would equal a short position. But right now, this is how to trade that opening bell, and that's taking that movement in that direction. In the next series of live trading the opening bell and why these two stocks did the very same thing, we will go on how consolidation tops are made with D minus directional movement price down in the next video series. Once again, I will recap and we'll talk about when they make the tops in the next series and why they come down and retrace. Okay?
So you would enter the trade in the second teeny. That's your buying point.
Well, my buying point is going to be, yeah, one teeny right there. You darn right. I'm not going to waste it because look at my diamonds above that diamond, Mike.
Yep.
Do you see that? That's called strength and ascending value. And then, yes, I can get a wick down. That's just a wick. So what? It didn't even come down and test my half bar. But right. Notice that it got right back above that teeny line in a small little movement. Because these don't trade a lot of volume now. Okay? But the thing about it is, that's the verifier and the qualifier. When you go through the resistance, you need this to occur. You always must have that bar. The diamond. Triple alert. He comes right back down. That's a machine. That's a high frequency machine. Went straight up in milliseconds. Milliseconds from the top right down, comes right down. But then how do you verify that? That little time moment is you just let it hold. It gained and it gave triple alerts that it wasn't going to go lower in the ratio, and you would know that that strength was strong even in that price manipulative area. In what we call high computing frequency volume trading, which is a non-human being. It's a machine. It's a computer that's in the middle of the buy and ask. And these diamonds will help you establish the directional price movements, Mike.
How many times would you trade that really nice big upswing?
I always get down here as a market maker. I can always add to my position at this level. So as I get stronger in it, I can start what we call volume management entry. Is that I get the lower volume entry always on the first pass. I add to the entry here as I go through. So I break up, I add 100 shares. I break up to this teeny clean, I can add another 200 or 300, but I'm adding into it as I'm getting confirmed. I've already got a cost basis down here, sure, on 100 shares, and maybe I'm adding 100 shares in here, and maybe I'm adding 300 during the breakout phase. Okay, and that's another thing that we'll talk about, volume entry management series, so that you will have a combination of entry management skills that you will be able to deploy and then operate accordingly. Whether it's the breakout, and this is a market maker stock, CMG. This is a new one that we had MMTs trading on that did extremely well with it. And we have traded this CME. It's a high flyer. A 1 delta could be high on some days. I mean, a 1 delta could be as high as, well, not high as, 1 delta in this movement is $7.38. And I know darn well that it probably moved a full delta on Friday. So once again, I'm going to keep this introductory short, but I'm also going to introduce Autozone. So you got AZ and how to do a gap up. And we're going to teach people about the gap up series. And we are also going to include a new trade, Autozone, which is up here, and how to identify that. So you're going to have 3 new additions. You're going to have CMG, CME, and you're going to have AZO. And you're going to learn how to trade gap opens and what they are qualified to do and various different segments.